Hi, I'm Megan Roberts, agricultural economist at Compeer Financial, and I'm joined today by Ben Duncanson with Legislative Affairs, also Compeer Financial. And we are here to talk about the government and a DC update. And I think there's a lot to talk about within that particular subject. Welcome to Compeer's Ag Edge, brought to you by Compeer Financial. In each episode, we break down complex agricultural economics, policy dynamics, and farm business topics into conversations that make sense for your operation. We're here to help you stay informed and confident about the trends and decisions affecting your agricultural business. Ben, it's been 2 months since we together last chatted about this, and a whole lot has happened. So with that as an introduction, I'll hand it over to you to give us the latest on what is going on in Washington, D.C.
Thank you, Megan. A whole lot has happened and nothing has happened at the same time, which is one of the lovely things about Washington, D.C. these days. I'm going to break the third wall here, people, and just let you know we are recording this on Wednesday afternoon, the 12th of November. Tonight, the House will be hopefully voting to end the shutdown that has been lasting for the last 43 days. This is actually, the House has now been out for more than 50 days out of session, so good to have them back in D.C. this afternoon and hopefully get the government back open by tomorrow. Just a little bit of an overview of the deal that I was actually struck. The deal was struck by the Senate Democrats and Republicans on the other side of the chamber, and it consists of largely is a deal that was placed on the table by Majority Leader Thune at the beginning of the month, but it consists of basically extending a CR for the federal funding up until January 30th to hopefully give them a little bit of time to get the remaining appropriations bills across the finish line and done.
I'm going to pause you there, Ben. CR.
Oh, I'm back into DC speak again,
Yes.
aren't I? Continuing resolution, which means basically you just change the date of which the deadline for you to fund the government it is. So it basically extends the current year budget until the X date where they decide to place the continuing resolution. For this one, it would be January 30th, 2026. Just as a little bit of a reminder, folks, continuing resolutions have become ever more common within Washington, D.C., given some of the struggles we have passing appropriations bills, especially over, let's call it, the last 20 years or so. So we are actually currently on a continuing resolution for fiscal year 2025 using the fiscal year 2024 budget. So when we say continuing resolutions have been common, they are extremely common because we're on one right now. So just a little bit of a reminder of that one. It does leave the possibility of another shutdown coming at the beginning of next year, but we'll cross that bridge when we come to it. This is where it kind of gets interesting for us, especially within the agricultural community, because part of the agreement that was struck between Republicans and Democrats was that they would actually pass a minibus, which contains 3 of the 12 appropriations bills that need to get passed every year. The 3 that were in question are actually military construction and the VA, legislative branch, so funding the legislative branch of government, and for us, USDA and FDA, which would be a big deal. That means that USDA would be able to continue operations even if they shut down the government at the beginning of the next year as well. So they are appropriated. If this were to go through as planned, they will be appropriated until the end of next fiscal year or the end of next September 2026. There's also, this shutdown was mainly caused by a large debate whether to extend the Affordable Care Act subsidies that were basically increased under the Biden administration post-pandemic to help folks afford health care that have to go to exchanges to get said health care. So that was a guaranteed vote in the Senate. Speaker Johnson, as of this morning, has not guaranteed the same vote in the House, but we'll see how that progresses as well. And then lastly, on the macro deal, and we'll get to another thing that's important to us within the agricultural community here in a second. Lastly, during the beginning of the shutdown, the administration actually continued its forced reduction or shrinking of the federal government employees. And actually, part of the agreement was that all of those reductions that have taken place during the shutdown are actually canceled. So those folks that were let go while they were off during the shutdown will actually be headed back to work come Thursday or Friday or whenever they actually open up the government again. And then there was also a commitment to continue to pay those federal workers that were furloughed during the shutdown as well. Lastly, and this was a little bit more unexpected for a lot of folks watching this situation closely, and that was a year-long extension of the Farm Bill. That was included as part of the Senate package and will be included as part of the package that the House will vote on this evening. A little bit unexpected. We did know that there was some time constraints, especially on the Senate side, to be able to get the remaining elements of the Farm Bill done by the end of this calendar year. The shutdown and the 43 days of lost work time also did not help that time crunch problem for our friends on the Ag Committee on the House and Senate side. So allowing this extension for a full year does give our friends a little bit more time into next year to get the final elements of the Farm Bill together. Just another reminder out there as well for folks that this request for a full year extension of the Farm Bill was one of the big requests from our friends at USDA to make it a little bit easier for them to run USDA programs over the course of the year. So providing a little bit more certainty is a good thing. However, for us that are hoping to see some relevant and important changes included as part of that skinny Farm Bill, we're a little disappointed that there's an extension to that timeline out there as well. But all things said and done.
I hate to break you up while you're
Oh,
on
no,
this
you're
great
good.
roll, but I think maybe let's talk a little bit, just level the playing field on Farm Bill extension versus skinny Farm Bill. Whenever we're talking Farm Bill extension, we're really talking an extension of an extension of an extension for 2018 Farm Bill. And when Ben's talking skinny Farm Bill, or sometimes folks call it Farm Bill 2.0, that would be the rest of a new Farm Bill that would join up with what was passed back in July. And so that's just a lot of stuff going on. And I thought it might be helpful to just level the playing field on extension is back with our 2018 for the most part. And then skinny Farm Bill would be finishing up the rest of a new one.
Yeah, because there's certain elements there on the policy side, even though a lot of the spending issues have been taken care of, that need to
Right.
be addressed. Because if we were to hit the end of the year, we fall back on some great permanent law from the 1930s, which is probably not great for the whole macro economy if milk prices were to spike that high as well. So this is one of the interesting things we find ourselves given the passage of the One Big Beautiful Bill, and that containing a lot of the traditional Farm Bill elements. It is a little bit of what's moving where kind of a
Yep.
situation. Some of the Farm Bill was actually extended it already for another 6 years. So for those folks with ARC and PLC, those checks, those reference prices have been updated and will be
As in
effective
July.
as of next year. So we're good to go there. But for us within the credit title space, none of that was actually touched under the One Big Beautiful Bill Act. And for us pork producers out there, such as myself, a solution to Prop 12, which is the California law that passed that limited what sales of what pork products could be sold in California, that was also not addressed as part of the One Big Beautiful Bill. Those are just two quick things that were not able to be addressed because they did not have fiscal impact, or i.e. they did not cost money, so could not be included as part of reconciliation. So we still hold out hope that we can hopefully see a quick passage of the remaining elements of the Farm Bill early next year, and hopefully provide a little bit more certainty out there for folks as they try to work through this little bit of a downturn in the ag economy. Having some access to some tools that would be included in that skinny Farm Bill 2.0, pick your favorite terminology and insert it, that would actually do a lot of things to help farmers that are in a little bit of distress or in that margin crunch make it through. So we really do hope that our friends in the Ag Committee are quite expedient in getting the remaining elements of the bill done. Speaking of some of the margin squeeze that we're feeling out there in the agriculture economy, Megan, since we last talked, there's been a little bit of an update on the whole trade front with our counterparts in China. Do you want to give the folks a little bit of an update of what we know as of now coming out of that agreement?
Yeah, absolutely. I think one of the phrases that you used earlier of a whole lot has happened and also nothing has happened is also something that we can use to describe a little bit of the China agricultural trade dynamics at the moment. So we got to go back a couple weeks in time, week of Halloween, October 31st. That week, there were negotiations that occurred between the US and China. And right ahead of those negotiations, we did see the very first new crop soybean sales to China. The Chinese state owned COFCO purchased a portion of some new crop beans, approximately equivalent to 6.6 million bushels. Or to use metric tons, it would be 180,000 metric tons. And no, I didn't just do that math in my head. I had to use my notes. And then, as they headed into that meeting, as part of some broader scale economic negotiations related to trade, there was an agreement to plan to purchase, and I am saying that for a reason, plan to purchase. Sometimes plans don't always equal confirmed purchases, but there's a plan to purchase 12 million metric tons of soybeans before the end of this calendar year. So before we switch over into the 2026 year. And then another 25 million metric tons of soybeans, which is approximately 920 million bushels each year for the next 3 years. So that would start in 2026. That is both a lot of soybeans and also maybe not so much because it's about the flat equivalent of where we were in 2024 trend line with some of our trade between the United States and China. Nonetheless, this has been seen as really positive in the soybean market, and we've definitely seen some increases in both cash prices right now here in the upper Midwest, and then also we're seeing some strength in futures prices. As time has passed in the last 2 weeks, we haven't seen a lot of additional action related to that agreement, but certainly there are some glimmers of hope in the soybean market in a way that maybe we didn't have before this deal was worked out. It was very, very concerning to not have any new crop sales to China at this time of year, because this tends to be a time in which they're purchasing historically quite a bit from the United States. And now we have at least some. And some is better than none.
Usually that's how math works, so I'm glad
Yes,
that's the case. What else
that's
was
the type
included?
of math I can even do in my head.
Greater than zero. Outside of the agriculture space, Megan, I understand there was some other elements that were included as part of that trade deal. Usually trade deals give a little bit of give and take here. Why don't you let the folks know about what else was included as part of that trade deal as well?
Yeah, so the soybean aspect was really something that I was watching from that agricultural perspective, but there were other broader economic considerations. So, in a brief summary, there was a commitment on halting the flow of precursors to fentanyl, a commitment by China on export controls on rare earth elements and other critical minerals, and to reduce Chinese retaliation on U.S. semiconductor manufacturers. There were also a few additional agricultural tariff related aspects that went beyond soybeans. Soybeans were really the hot topic within agriculture, but we did see some discussions related to things like chicken, wheat, cotton, sorghum, even pork and beef were included, though some of that trade was continuing to happen despite the summer and spring tariff disruptions.
Well, hopefully we'll see us a little bit more progress on all things trade related, whether it's China or some of the other trade related conversations that are going on from some of our key trading partners across Europe and Southeast Asia as well. Speaking of all things numbers and some trade volumes, we are looking forward to the next WASDE report after combines had stopped moving across the majority of the country here. Thanks to a lot of folks at USDA being called essential workers, it looks like we will get a WASDE report regardless of whether the federal government opens up this Friday. Megan, why don't you just give some of the folks a little bit of an overview of your thoughts on what we might see coming and all things processed for our friends at the USDA when it comes to WASDE.
Yeah, so the World Agricultural Supply and Demand estimates for October were skipped because of the government shutdown. And even before we knew what we know today about the government possibly reopening, and probably when you're listening to this, it will be reopened or will be past the shutdown, is we knew that this Friday's WASDE was going to come out. So November WASDE was delayed about a week and was planned for 11 o'clock Friday, November 14th, even before the shutdown negotiation deal was reached. So within the WASDE, we have all of those things that we were just talking about with China and other countries going to be reflected in our export demand numbers. We'll have to see how the USDA interprets those. We're going to have hopefully a better insight into what production is going to look like for this harvest season. Typically in our October WASDE and our November WASDE, we tend to have a downward pressure on production numbers. So across previous years, we have seen the USDA in the October and November WASDE push down the yield per acre for corn and soybeans. Is that going to happen this year? I don't know for certain. No one truly knows for certain until the WASDE is released, but it certainly is possible. And I thought one of the ways that we could talk about the WASDE while not having the WASDE in front of us is to go back to September and just do a quick refresh of where we were in September for corn and soybeans and where we might go as we're headed into November. So back in September, the USDA estimate for soybeans, I'm going to start with soybeans here, it was 53.5 bushels per acre, and that was going to be on an estimated 81 million acres for a grand total of an estimated 4.3 billion bushels harvested in 2025. In the September WASDE, we were at a $10 projected farm gate price. So what might happen with soybeans as we move into this now skipped October and slightly delayed November? It's really hard to say. And I am not going to put those predictions on it, but I will say that things like the China trade deal will have a likely impact on how USDA is looking at global export demand. We also know that we are continuing to have this is maybe a little bit more of a corn thing, but I'm going to talk about it in soybeans at the same time because there's crush related aspects for feed. We just have a little bit of a smaller livestock herd, particularly in beef. And so for things like feed demand, we're seeing a little bit of a trend down on that, more so for corn, but I'll mix the two crops here. And whatever happens, we have to remember that this is the first data in over 2 months for the traders to get from the USDA. And so I think anything is going to cause some reaction. It doesn't have to be big up or big down, and I still think we're going to have reactions on the market. And I think that's true in soybeans and corn. Unless, I don't know, even maybe no changes would cause a reaction at this time, just because it's been so long since we've had a WASDE. Let's talk a little bit about corn. And corn back in September had a estimated yield at that point of 186.7 bushels per acre. And up here in the upper Midwest, we certainly saw areas that were well above that. Of course, this is a national average, but that 186.7 bushels was down from a really surprising August number of 188.8 bushels per acre. And that is across 98.7 million acres, which would be the highest planted acreage, if that is truly what is out there, since 1936. And if we harvest as much as the USDA anticipated in their September, it would be the highest since 1933. And I'm going to throw a trivia question to you, Ben, at this point. Back in the 1930s, so I just told you that we had, this truly impressive amount of corn back in the 1930s. That's taking us all the way until 2025 to possibly achieve as many corn acres as we had back in the 1930s. What about soybeans? What do you think we had in the U.S. for soybean acres in the 1930s?
Oh, I can't even hazard a guess.
We just got to over 1 million acres in the 1930s. And it took just another 10 years until the 1940s until we had increased that by tenfold to about 10 million acres. And now we're at 80 plus million acres. And so the reason I wanted to talk a little bit about that is the soybean domination that we've had over the last 100 years in the United States. There's a lot of talk right now as to, do we need as many soybeans as we now have? Our corn is roughly the equivalent of what we had back in the 1930s, but soybean is where we have really expanded our production. And in fact, this is nerdy plant science stuff, but prior to the 1930s, really just couldn't effectively grow soybeans in this part of the world. So, we needed breeding and all sorts of things to make it possible. But we expanded our soybean production because we had demand for it. And we took down the acres of other crops like oats and small grains because we had less demand for it. And now the question becomes, will we continue to increase soybean acreage? Or has our demand really changed over the last couple of years? Not just because of this last year of China trade negotiations, but just what's next, I guess, is the question. And that's a rhetorical question. I don't know, unless, Ben, you want to try to answer that rhetorical question.
Oh, I've never been good at predicting the future, whether it's election or otherwise. Probably why I'm here today. So, interesting fun facts on all the growth in soybeans.
Yeah, I thought they were fun facts. I'm good for fun facts. I am bad at future predictions. So I don't have a lot of future predictions in this exact moment, but I do have a lot of data and fun facts. So even though we just both said we are not good at future predictions, do you want to talk about ad hoc payments?
Yes, hot topic in DC these days. I had the privilege of attending the Farmer Credit Council annual fly-in last year that we do every other year. And that was one of the topics that we are having a lot of conversations about, both within the Farm Credit family and with our friends on Capitol Hill. We are watching quite closely some of the developments that will come out, whether we will see another round of ad hoc assistance coming out later this year into early next year to help bridge the gap between some of those price increases that we previously referenced that were authorized as more part of the One Big Beautiful Bill Act earlier on this year until they really take effect and payments go out the door next fall. So they are talking a little bit more of this in terms of a bridge payment. We still don't know how that's going to function. Our friends at USDA, due to the shutdown, have been quite clear that they do not have the staff or the resources to implement such a program while they are shut down. And once they get fully staffed again, that's when they'll start start to have a little bit more thought and forward momentum and more conversations on what needs to be done in order to assist some of those farmers that are on the margins as we look towards the end of the year and renewal season for us within the lending industry as well. There are some tools that are going to be made available to our friends at USDA as part of the budget negotiations to reopen the government. They will replenish the CCC up to that $30 billion. That is its usual high level. So that does provide USDA a little flexibility out there as well. So hopefully we'll see our friends within the administration and our friends within Congress work together to try to figure out what is the most appropriate solution to some ad hoc payments for farmers out there at the end of the year. Just a little bit of reminder, folks, for us outside the Midwest within the rice and cotton industry, they have had this down period within their markets a little bit longer than we have within the corn and soybean markets too as well. So there is some need out there for some additional assistance to help bridge that gap in time until we can get to the end of the year. So we'll continue to keep an eye out there. Nothing is guaranteed ever when it comes to ad hoc payments, but we'll see what ends up coming about as we move closer towards the end of the year. Talking about the margin squeeze and all things, in addition to hopefully some increased prices, which will help relieve the margin squeeze, we continue to see some steady, if not increasing, input prices. One of those input prices is interest, top of mind for a lot of producers out there as well. The Fed has had a meeting quite recently, Megan, and since we last spoke, so do you want to give folks a little bit of a recap of that past meeting and what we might be seeing ahead from our friends at the Federal Reserve when it comes to rates going forward?
Yeah, absolutely. So, about 2 weeks ago, the Federal Reserve, which is not a governmental agency that is affected by the shutdown,
Self-funding.
they're
Good for them.
self-funded and they are considered a quasi-independent agency. And so they have been chugging along as is pretty much normal during this past month and a half. So they met at the end of October and they did have a drop at their October meeting. So that would be a 1/4% or 25 basis points on the Fed funds rate. And that was on top of the cut that they made at their September meeting. So we've had 2 back-to-back meetings with a cut to the Fed funds rate, and that has brought that down now to a 3.75 to 4% target range for the Fed funds. Of course, if you are listening to this, you probably know that that is not what your current interest rate is. The Fed funds target range is going to be that kind of baseline, and then the market is going to interact to set, what is going to ultimately be consumer interest rates. And what is nice about this fall as compared to maybe last fall when the Fed was also making similar 1 to 2 cuts per meeting is that the market is going in the same direction on their interest rates as what the Fed is doing right now. A year ago, when the Fed was cutting, the market was still raising those interest rates and they went in an opposite direction. And that's just another reminder of that the Federal Reserve ultimately does not set consumer client interest rates. That is a market interaction, but they're setting this base Fed funds rate. And they're doing it based on what's going on with inflation and the jobs market. And right now, the Federal Reserve is more concerned about where the labor market is as compared to where inflation is. So inflation remains above the target of 2%, but we're seeing maybe a little bit more of some softness over on the labor market side. What has been affected by the shutdown over at the Federal Reserve is the data that they're using. So they have had to make their decision in October based on some relatively dated, not too badly dated, but some relatively dated inflation information. So they tend to favor the PCE for their inflation measure. And that information is from August of 2025. And they use the Bureau of Labor Statistics for their unemployment rate and their jobs growth data. And that is also backdated to August. We have had, since the shutdown, one inflation measure, the consumer price index, that was kind of similar to what Ben was talking about with the WASDE, where we had Economist brought back as essential. This happened over for the CPI as well. So not the same economists, but economists were brought back as essential to get that report out of the door. And for the month of September, inflation in that report was at 3%. And that's not unusual for that to track a little bit higher than some of the other inflation measures. Okay, so I've said a bunch of numbers again. That seems to be the trend of today. What do those numbers mean? Well, as we're heading into the last Fed meeting of 2025, which is going to occur in December, will the Fed continue their trend of doing one cut, or will they not? That is the question. And this meeting, more than really any other Fed meeting, the entirety of 2025, has folks a little bit more puzzled. It's sort of a 60-40 split on what experts are thinking the Fed is going to do. So a little bit favored towards, yes, they're going to make one cut, 60%, about 40%. And it depends on the day, like when you look up these numbers, but I'm just using round numbers here. About 40% say no, they're going to hold tight. And it would be because of inflation, probably, that they would be concerned about doing another cut. So I still think the interest rate outlook is for a slight moderation, meaning a slight lowering as we head out of 2025 into 2026, but a little bit more uncertain about what is actually going to happen in that December meeting. Will they or won't they?
Uncertainty seems to be a popular word these days in a lot of things, economic and DC policy. It'll be interesting to see. We'll get some numbers now that the government's back and open between now and then. And for all you econ nerds out there, Jay Powell's speech after the last meeting was quite interesting to listen to because he did address the lack of data that they had to make this decision off to as well. And so it'll be interesting to see 5 years from now when we get to see those notes coming out of the Federal Fund Open Market Committee meeting, what was actually discussed by the board members there as well. So many interesting things ahead now that the government's back open and we get a bunch of numbers and we head towards the end of the year with all things government funding, farm bill policy, and interest rates, and hopefully get some USDA numbers in front of them as well. So that's basically our time, folks, for here today. I cannot let Megan, however, get away with the only fun fact of the day here.
Oh, a fun fact. Love that. We need something to counteract all of our numbers, because it was, I love your phrasing, bunch of numbers. That is a good descriptor for today's episode.
Yeah. For those folks out there familiar with the history of the farm credit system, we were actually modeled off of the Federal Reserve and were authorized just after them. President Woodrow Wilson in 1960 was actually the ones that created the original farm credit system that we've evolved into the farm credit system that you know and love today. So kudos to our friends at the Federal Reserve. They've had a fairly good model that we've largely built off in the past. So, and as being the first GSE in U.S. government history as well.
You gotta stop with the acronyms.
Government-sponsored enterprise, that's what GSE stands for. Like our friends at the Federal Home Loan Banks and Freddie and Fannie that came after us as well. So that's not the funnest of fun facts, but a fairly good way to end with not quoting a bunch of numbers at you. So we'll let it be for now and look forward to you joining us next time we're in the feed. And until then, happy Veterans Day, and thanks to all of you that served now that we're a day after Veterans Day, and we'll talk to you all very soon. So thanks, everybody.
Thank you for listening to Compeer's Ag Edge. You can follow us on Apple Podcasts, Spotify, or your favorite podcast app. For more agricultural finance insights and resources, visit Compeer.com. That's COMPEER.com. Until next time.